right, we call to order the March 6th meeting of the Montgomery County Employees Retirement Board. Seeing all members present. We already did. I will ask our CFO to lead us in the pledge of allegiance.
States of America, which the republic for which stands, one nation, under God, indivisible, with liberty and justice for all.
Is there any public comment?
No public comment.
Public comment. Moving on to the approval of the December 2024 minutes. Make a motion to approve those minutes. Is there a second?
Second.
Seconded by Treasurer Jason Salas. Any objections? Any comments? All in favor?
Aye.
Aye, minutes are approved. And CFO, do their tone, will take us to the place of the time.
Thank you. Just few comments before I turn it over to Kathy. Okay, so with the calendar year ending 2024, we ended up making 100% of our plan pension plan contribution. That was 26.3 million. So that 2024 was the fourth consecutive year that we put 100% of our required contribution into the plan. For 25, we're budgeted at 30.1 million. So we will be putting in 7.5 million per quarter into the plan each year, reallocated by quarter. Just an update on the actuarial valuation report, which is currently being updated as of January 1st, 2025. We expect that probably by meeting in July, the results will begin and that'll be presented to you formally by the actuary. Just quick comment on overall demographics. So as of the end of the year, the pension plan number of retiree invested participants increased by 3.4%. So we have 2,652 retirees and 470 participants that are vested in the plan along with the county. So with that, I'll turn it over to Kathy.
Dave, quick question.
Yeah.
With the actuary reports, what'd you say, June, July, what'd you say?
If we stay on track as we did last year, typically it comes out around June and then it's presented to the board formally in July. So we'll, as soon as it's released, we'll provide it to the board. If it's sooner, a lot of this falls in the controller's office gathering data for them, and that's happening right now. We're trying to put a push to get it done sooner if we can, because we're interested in seeing what the actual contribution is going to be. We're working off a budgeted number of 30 million. So
that will that be, I don't remember the timing from last year. Is that the report that we start looking at if we can make a pension contribution, hit a COLA increase or not?
yeah, that happens once a year.
Right.
That would have to be in the fall, and
Right.
they'll put together, you know.
So that's a different report. That's
Yeah,
not part of
that'll come after the valuation comes out, and
Okay.
that'll actually tell us, valuation will tell us the percentage of funding overall. Remember, we fell a little bit short of
Right.
80%.
Yeah.
We're hopeful that, you know, we get above 80%, and then, you know, that discussion for the COLA can happen for, you know, next year.
Well, with the 4 years of 100% contribution and all that, and if it's a 5-year look, you might get lucky this year and be at least at 80%.
Yeah, I mean, the market cooperated, you know,
Right.
by the end of the year, as Kathy's gonna present, so it'll be interesting to see how the numbers all shake out once the valuation's done.
Is there any way to project that?
I'll ask the actuary after we give them some of the data, like the investment performance, some of the other information, if they can, you know, ballpark if, you know, we might be in a better place. So that way the board can start thinking about that, but you get the formal analysis from them and the COLA calculation typically in September, and if the board was to approve a COLA for 2026, it would be effective January 1st, 2026. The action would have to be taken before the end of 25. So that'll be the last quarter.
And
So the funding level for 2025 will be considered.
Yeah, so the funding level I was just talking about is the county's contribution. We've been at 100% for the last 4 years, but the overall funding percentage for the plan overall was under 80%. It has to be over 80%. It's considerable.
Through, what's the period again?
That will be as of January 1st, 2025 evaluation.
Okay.
When we get the actuarial report, probably in June, we'll know if we're at the 80% level or not.
Got it.
Right.
And what they're, most, one of the things that they have to do is figure out the projection of what our requirement will be for funding in the future, not just what the market was, but what the projected requirements will be.
But we'll reach out and see if we can get an early, preliminary estimate based on some of the numbers that we can provide and share that with the board. As soon as we get that. Okay?
Yep.
Great. Yeah.
Good afternoon, everyone. Great to see you.
How are you?
Oh, great, thank you.
Good.
I just wanted to start off and was fortunate enough to be invited to your 2024 year review. So I just want to congratulate you. I was really impressed just seeing it all laid out, all the great work that you've done for Montgomery County. So being a resident of Montgomery County, thank you. So congratulations on your success. So I know you're running behind. I can do this in a couple minutes. Or so you let me know.
Good time, Marks.
Probably about 10 minutes.
Yeah,
So
good time, Marks.
feel free to ask questions. The good news is I have good news for 2024, but certainly
Yeah.
we all know what's happening today and there's lots of volatility in the market. So I can speak to that too. So I'll speak to both. So if we can start on the executive summary, lots of numbers here, but really just reflecting on where you've come for the year. So again, on slide 3 here, you can see you started the year at 597 million. And again, we combined the plan in February. So one consolidated number started at 597 million. Taking us through the third quarter was up at 663 million. Down slightly, but we did end the year 652.9 million. And if you look at that in contrast to where we started, so in addition to your contributions, it was a very successful year. You'll see the fourth quarter return to the market did pull back slightly. You were down about a little over 1%, but year to date, 11.7%. So congratulations, that's a really remarkable number. I looked, I have your calendar year numbers in the book. So speaking of kind of looking at these averages, last year, the portfolio was up 15%. So you have some really strong 2 years. Unfortunately, if you remember 2022, your portfolio was down 15%. Markets were really significantly down across the board. So that number continues to factor into your averages and your long-term return, but certainly really had a successful year. I do have here the January number, and I can speak to what the market's done since then. So January was another positive return for the portfolio. You can see the market value went up to 667.3 million, and you earned 2%. The portfolio earned 2% in January. Unfortunately, as of yesterday, so if you look at the 667.3 million, yesterday you're down to 666.2 million. So the portfolio's lost about $1 million. It has really been volatile. Especially the last week, markets have been down pretty dramatic, and we all know, you can count the times I say tariffs in my speech, but we certainly know the uncertainty and what's happening in the marketplace, and that's really reflected. So I'll spend a few moments just to let you know how the performance of the portfolio was for 2024, and then we can talk about what we're seeing today. And again, I can keep it short and sweet if you like, but just a few comments. When you look at the portfolio on the executive summary, equities is really a key contributor. You can see it was up 15% for the year. And we entered fourth quarter really positive, information about the presidential election, concerns or optimism about tax cuts and deregulation really led the market to excel. But we did have a little pullback, with concerns about tariffs and inflationary pressure. So you saw December was a negative month, but all in really positive for US. You'll see in a moment, international had a challenging quarter. You had a strong US dollar, concerns about tariffs abroad, and that really pulled down the equivalent of performance for international. Fixed income, an extremely volatile quarter when you think about interest rate and you think about what the Federal Reserve cut rates 3 times in the fourth quarter. but our 10-year yield went up. Interest rates were extremely volatile. A lot of concern about inflation continuing to rise. Again, we saw the 10-year rise despite Federal Reserve cutting 100 basis points. And we talked about that last time with mortgage rates still getting hit with that 10-year being up to high. So again, lots of volatility. And it's interesting, a lot of my prepared slides talk about where we were in the beginning of the year and our concerns about the 10-year hitting 5%. God bless you. What happened recently, we're seeing that 10-year come down a little bit. So it really speaks to the volatility that we're continuing to see. And then finally, alternatives. You have two funds in your alternative exposure that are one's structured credit and another one is a hedge. They continue to add value. The structured credit fund was up over 20% for 2024. And your special situations funds over 17. So continue to add that diversification. And when you think about what's happening in the market today with the pullback, that alternatives is really a source of return that is uncorrelated and really beneficial for the portfolio. And and you'll hear, but at the end of the day, the asset allocation is most important for what we're doing within your portfolio. Any questions on the executive summary? If we can just flip through. If you want to go to slide, we'll talk about the markets quickly on slide 5. This just shows 2024. I won't spend a lot of time, so we can talk a little bit what we're seeing today, but you can really see large cap is that first number. Again, these are the equity markets. Large cap had an amazing year, particularly large cap growth. The Magnificent Seven that we've talked about several times, really responsible for what happened in 2024 with significant return. And small cap eked out a gain, but small cap really pulled back pretty significantly, again, as concerns about inflation continuing, and that continues to hit more domestic areas of US. You can see in world equity and ex-US there, an emerging market, the blue bar represents the fourth quarter, pullbacks of over 7% for both of those areas. Again, the strong dollar, concerns about tariffs really hit. But what's interesting, international is the best performer in 2025, which many would not have expected. Again, going back to the key points of diversification. Fixed income was down. We talked about the volatility of rates. So we saw that across the board. However, high yield, emerging market debt areas that you have in your portfolio from fixed income were really beneficial. For the next few slides, I'm just going to spend, if you can keep going forward, I'm going to skip some of these. If you can pause here for a second. Oh, there's one back. So I have a bunch of slides about the forecast. Did you have a question?
Well, yeah, you're about to say it.
Yeah.
These are forecasts of 2024,
2025.
of 25.
25. Yeah,
Okay, the year to come.
the year to come. Yeah. And that's what's so ironic about when you look at this and what's happening today. So first I thought, I'm not going to talk about it because it's a little bit old news, but I think it's so interesting. And it shows the dynamics and how not to react to what's happening in the markets currently. So these are well-known forecasters, them, you can see them at the bottom of the page, Oppenheimer, Wells Fargo, these are key strategists. And every year they come out before the beginning of the year, before January 1st, they come out with a prediction of where they think the S&P 500 would be. And as you can see, majority of them, half of this page is 20%.
Yeah.
We were clearly down closer to kind of more the 15-10%. But when you think about when we started the year, again, we have great GDP, strong economy, consumers are spending, unemployment looks good. We have a Federal Reserve that's cutting, and then we have an administration that appears are going to be extending tax cuts and deregulation. So significant euphoria across the board. And if you continue on, our perspective was there's some great things that could be happening and definitely some headwinds. So I think this slide is so interesting because it even speaks to what we're seeing today. We're seeing it's a balancing act, and your perception of where that S&P would end really depends on a number of things. So on the left-hand side, you have the cons or the tailwinds, the headwinds, and on the right are the the pros or the tailwinds. So looking at the positives, less regulation is going to boost earnings for companies. They're going to have it's going to help the markets, it's going to help risk assets. Lower taxes, lower corporate taxes. Again, it's going to help the markets, help the economy, fiscal stimulus. But on the right-hand side, tariffs can lead to increased inflation. Immigration policy, you can look at what's happening, and that tends to lead to increase in labor wages, which in shortage in labor, which is increased wages, which really can hurt us. So you can kind of see re-accelerating inflation, which we're seeing, and we saw that even prior to any conversation with tariffs. and higher interest rates. So it's really this balancing act. So really, when you look at where most predictions were in the beginning of the year, it was going to be a great year. And we sit here today, the S&P 500 from negative territory. We're down about 1.5% year to date. Since the election is negative too. So again, it's this balancing act of kind of the market sometimes just reacts on a short-term basis in the news. So you have the positive news and then there's concerns with what's really happening. But where we stand is somewhere in the middle. But I'll tell you why it's important. It doesn't matter what I say. It doesn't matter what these key strategists say, because on the next slide, I think it might be one more slide after that. This is a very interesting slide, a little hard to read, but what this is where a number of these key strategists predicted the S&P would be, the S&P 500. So if you just look at the last column there, which is 2024, the year we just went through. So you can see their target where they thought the S&P would end, and you can see the actual. So if you look down, the actual varied anywhere from 13% to I think it was like 28% incorrect. And again, these are key professional strategists of the largest investment advisors. So I have, 3 words for you or 4 words for you at the bottom of the page, which is really what our solution is and how we monitor and manage your assets. Asset allocation, diversification, and discipline. We're not reacting to what we're seeing today. You have a very strong allocation. You have significant assets that provide that return, but you also have assets that provide that risk management that are supporting you now in getting your goals of extending those cost of living increases. So it's really managed. Our strategic asset allocation, which by the way, we're going to revisit again this year. SCI is a co-fiduciary of your plan. We officially visit it at least once a year. So you remember we went through that whole process when we combined the Vanguard assets. We're going to officially look at that in the spring, hopefully, and determine if there's any tweaks that we need to make. But at the end of the day, your allocation is long-term strategic. There are absolutely some funds within there that look at some of the short-term, and I speak to them occasionally, like the dynamic asset allocation fund. We have positions on inflation, on central banks and what they're going to do, currency. So we definitely have some short-term perspective. And each of our funds are managed by managers that have a perspective on the economy. But at the end of the day, the key asset allocation to asset classes should be strategic and long-term, and that's it.
Yeah. So quick question. These were all a year out.
Yes.
And the one thing that's interesting though, is it seems like they tend to be going in the same direction.
Yes. Right.
Yeah, so what is that? I don't know
Yeah.
what that's.
Because I think that markets are forward-looking.
Mhm.
So again, when you think about what we were entering in this year, all the things I mentioned, the economy is still strong. I know that they're thinking GDP may flounder a little bit this first quarter, but still strong. Consumers are still spending. Still have a lot of good fundamentals within the marketplace. And then if you have an administration that looks like we're going to continue to, again, cut taxes and cut regulation, all that positive euphoria, but then when you see these little market, just before I walked in, I think it was announced that tariffs won't go through with Mexico until another month, until April. So you saw just, the markets just gyrate up and down based upon their short term. But when these predictions are made, they tend to try and look forward, looking at what's happening at the same time. So they all there's always an outlier. There's always contrarian, and we do all kinds of studies to say, well, what if we would have listened to the contrarian? But the good news is that's not how we're managing our assets. I think it's all very interesting, and these slides are always very interesting. I have clients clients for years when I walk in, they would say, "Okay, Kathy, what's the S&P 500 going to end the year?" And I was like, I don't know, and it doesn't matter because we have a diversified discipline process that gives you exposure. Clearly, our investment point of view is very important, and that's how we manage as well. But again, more for interesting perspective than how we're managing your full pension assets.
Well,
Go ahead.
I was gonna say, I think the point is that you can't chase the market on a daily basis because there's a lot of other indicators that happen. There's market manipulation that goes with major investors that have controls in certain market segments that they can move money around, and when they do that, it has a direct impact on the market. And then, there's a lot of talk about tariffs, but nobody's talking about the trade imbalances
That's
that the tariffs are trying to even out.
Right, and the
So-
capital spending in the
Right,
US.
there's a lot of
Absolutely.
complexities, and unfortunately, the media
Yes.
focuses on the 6 letters or whatever it is. I didn't count them, tariffs, 7 letters.
Right.
You know, but there's a lot more going on that nobody reports on. So it's gonna be an interesting couple months, but I think,
Absolutely.
I would suspect that as the year goes on, everything's gonna kind of balance out.
Yeah, and we feel the same way. I mean, we're
Yeah.
definitely expecting volatility. But if you look at the euphoria at the beginning of the year, you look at where things are now, you know, it'll smooth out. Hopefully, the expectations of where we're heading will be a little more clear. And we won't be living day to day, you know,
Right.
with uncertainty. And at the end of the day, markets hate uncertainty. So whenever you have that, you're going to see the ups and downs. And you're right, you can't really look at that. I mean, even entering into the year, everyone said US is the place to be. And again, international, Europe is the best performing asset class so far in 2025. At least it was until a couple days ago. So it's very interesting. It's interesting conversation.
Right.
But certainly, you know, when you want to make sure that when you look at your portfolio, you have exposure to all asset classes, US equity, international, developed, emerging markets, even in fixed income, high yield, which is a more, you know, a unique asset within fixed income that has a little more risk, but gives you opportunity for return. And then your alternatives. We want to continue to have that conversation because in private areas is where we can get you additional return as well. But it's that diversification that helps balance out. So you don't have, when you have the pullback, it's certainly important not to go backwards and lose, you know, the great work and great progress that you guys have done. I have the performance numbers in here, but you let me know if you want to walk through them or you want me to wrap it up.
What page are they on?
So December, sure, we have December and January in here. You know, December, I mean, or calendar year 2024 or January.
I'd rather just speculate about.
We can talk about today. There are a bunch of manager changes, which I'm not going to go through, but I do want to reinforce that FCI is making within your funds, there's managers that manage the money. We're making changes to those managers. And a lot of those changes revolve around better risk management. There's one firm that two portfolio managers left the firm and they went to a new firm. And we felt so strongly about them that we followed them to the two firms. So, you know, we're switching to a brand new manager. So we essentially fired that sub-advisor and are following them. And they're going to a firm that not many may know about, but we know the portfolio manager. So that's the type of due diligence and fiduciary oversight that we bring to who's managing the money within a mutual fund. So there's a lot of detail in there, which I won't go through. So the December report is on slide, we're in my reader 17. And this just speaks to, I'll focus on year-to-date numbers here. So 11.7% is your year-to-date return. That's your calendar year 1 year number. You can see your net number is 1169. And I think an important number that we used to talk about a little before, not as much now, is that when you look at your index, your portfolio blended index, that's 9.6%. So that's essentially 200 basis points or 2% above an index. And that speaks to the level of active management. You have 50% of your portfolio in what's called passive funds, index funds, which do not provide active management above a benchmark. So the job of a passive fund is just to completely match that index. Because, you know, we were able to have some of your portfolio and some of those actively managed funds, which managers are kind of picking and choosing those securities that they have faith in. You did get additional. So that gives you additional 2% return, again, to continue towards your goals. So that was, we may not see as much of that going forward, again, because 50% of your assets now are passive within the equity funds. So you can see looking on a year-to-date basis, which is the same as the 1 year, 15% for your equity. US, you know, your US Vanguard stock fund, clearly the dominant. S&P 500 has returned over 25% the last 2 years. That has been the place today. And again, a lot of it was Magnificent Seven, but clearly, you know, you have significant exposure to that, which is wonderful. International fund did well, 5%, but certainly not as strong. Your fixed income area, we put in a little limit duration, which benefited you. That's shorter duration. And when we think about rates were rising on the long end of the curve, that shorter duration helped you. And then you can see there's other areas of fixed income which benefited the portfolio. And then finally, on the next page, we have your alternatives. I gave you those numbers in the beginning, 20% for structured credit, 17% for special sits. And then your dynamic fund is the fund at the bottom there where we actually take a shorter term implementation. And that's where our outlook was higher inflation. Our outlook was that central banks will diverge. We had certain trades on the US dollar versus the euro versus the yen. So different trades that benefited the portfolio as well. And we're actively looking at that based upon our short-term point of view. And I will end on slide 19. This is your calendar year, which I think is very insightful. Again, your year-to-date 11.71, but you can see last year, a great year, 15.7%. But then unfortunately, year 2022, down 15%. You can see 2 years in a row will help soften some of that blow that you've had. But if you're averaging out your 5-year numbers, you can see beyond 2022, you have some healthy returns. And then January follows, but I don't even think I'll even go there. January, just about every asset class is positive, but we've pretty much lost that in the last month and a half. So again, we don't look at the markets daily. We certainly, don't recommend anyone does that, but certainly in for a little bit of a fun ride for the next 4 months.
So that 2022 number is potentially could impact our COLA opportunities. Yeah,
Averages out, right?
Yeah.
Years.
that comes into that. Huh?
Yeah,
Yeah,
it's a weighted
Yeah.
yeah,
And that's what we're trying to get the actuary.
Right.
Yeah, I know SCI can do estimates, but I think it certainly, because you're so close with that 80%, it makes sense to have more of an accurate
right.
from your actuary. But yeah, you're not alone. That actually 15%. I have seen many organizations down at 20% in 20%. So that's really been a terrible.
Oh, yeah, it was a good year.
Yeah, and this is, I think we get a little spoiled when you look at the S&P 500 the last 2 years, over 20%. I think we're not used to seeing the markets pull back, and I think this is why it's really important to really have that diversification, because we could get more pullback. They say it's common every year for the S&P to pull back several times, 5 to 10%. It's common. I can show you a chart every year in which it's expected to happen. And if it doesn't happen, then there's concern that it gets too problem. Yeah. I will end it there, because I want to make sure that you're not being respectful. Yeah.
So I think it's interesting, since inception, 2013, we're almost on our interest rates. So right now,
That's right.
It's a snapshot.
Yeah, that's
But that was when the county moved over to this model, right? That where we want with the SCI. So when you look at it, and that's the model, right? The 7.5% assumption. But
So, and that's what we strive for the long term, to get you that number. That really helps you with a lot of the goals that you're trying to satisfy from an actuarial perspective with your funding. And that's our number one goal, to help with your funding. Any questions? I can talk more about what's going on today, but I think you guys have been sitting all morning. Oh, yeah, that's always, Dean had asked me, but I threw the card in the back, the quilt. That also reminds you, asset classes go in and out of favor. You look at international has not gone up for 10 years. Has not, US for 10 years, international. So if you look at it, US has been 17. Last decade that it's not. Thank you. Sorry, I thought I was following you behind it. Oh, it does look like 2017, yeah. But if you look at a 10-year number, I guess maybe that's my perspective, you'll see the US, but it's, it just shows you basically kind of, if you think that you want to invest. We have a study, which is so interesting to say, if you invest in the top performer the year before, how do you look? If you invest in the worst, but really that's the value diversification. What's interesting is you see US large cap up there a bunch of times. So it's really doing, especially the last 2 years, it's really been the dominant. Yeah. And then that concentration that we see in the S&P 500, I think that's what a lot of people are concerned about, the Magnificent Seven, AI, that's pulled back, but that's really led the returns in the last years. 7 stocks, 50 to 60% of returns. Questions? I talk fast to try and go fast. Always a pleasure to see you. Thank you very much.
Thank you.
Going on, in this meeting, so. I'll make a motion to adjourn the March 6th, 2025 meeting of the County of Mongomery Retirement Board. Is there a second?
Second.
Mr. Fellow, any comments? All in favor?
Aye.
Aye, meeting is adjourned.